Hello and welcome back to Time is Money, brought to you by TradeMonster.com, where you can trade stock for just $7.50 flat and options for just 50 cents. That's TradeMonster.com, sister company of Option Monster. Here's what we were doing this week, folks. We saw the unusual activity in the puts that we talked about a week ago on the website, as well as CNBC. That put activity in HSBC, big British bank. That rollover activity did occur. Last week, Wednesday, of course, Morgan Stanley came out and said that they think that HSBC, which is the ADR symbol here in this country, needs to raise some $30 billion. That caused the stock to fall into the low 40s from 47 when we established our puts. But then it just kept on coming. And of course, over the weekend, when we were celebrating Martin Luther King Day, the Brits were trading and they were nationalizing RBS, basically taking some 75-80% of that stock. And as they did, well, you know what that did to HSBC, you know what it did to Statestreet and to Wells Fargo and you name it, US Bancorp, they all rolled over. Well, on that roll, because you can always use that to your advantage, even if you weren't in on the short side, which we were, knock on wood, in on the short side, you can also do what I did 2 days after the sell-off. We jumped in and bought State Street down at $16.10. Why? Because the put activity had been exhausted. The stock was down some 35%, and we thought it represented a great value. And since the volatility spikes so dramatically when stocks fall like this, we were able to get in there, buy the stock for $16.10, sell the February 15 puts, and sell the February 17.5 calls in what I'll call a covered strangle. And I'll talk about one for next week in the second half of this video. So that covered strangle in State Street, we generated $5.30 from the sale of the put and the sale of the out-of-the-money call. That meant that we would be delivering shares if the stock was $17.50 or higher by the third week in February. We would be delivering those shares at $17.50. Since we bought it at $16.10, there's a profit of $1.40 plus the $5.30 means we're making $6.70 on a $16 investment in 3 weeks. Like those numbers, folks. And the other side of the trade is, okay, if the stock rolls over, goes down, we've obligated ourselves to buy shares because we bought, or rather because we sold those 15 puts in February. That would mean that we'd be buying the stock at 15 minus $5.30, the premiums that we received, which would be $9.70. So if you put that together, we bought the first tranche at $16.10, and if the stock fell below 15 for expiration, we would be put shares at $9.70. Effectively, our average cost $12.90. How do you beat it? I love the odds. That's what it's all about, moving the odds into your favor. That's what our software at Option Monster and our sister company, Trade Monster, that's what that software does, helps you maximize your potential reward for the risk that you're willing to take. Now, if you come back from the break, I'm going to tell you about covered straddles. I'm going to tell you about covered strangles, and we'll talk covered rights for some big earnings reports next week, right after this. Okay, welcome back. Now, again, our sister company, TradeMonster.com, you got to go over and check it out, folks. It's the only place that you can get full streaming quotes right onto your trade ticket without downloading any software. You just, anywhere from the net, you can just get onto this site, TradeMonster.com. You open your account, transfer in from another broker or whatever. And by the way, thank you for all of you folks who've been coming in from Thinkorswim. We appreciate that. And once once you've funded your account, you're good to go. But you can also use all the educational material and all those graphs and charts about how to set up your trades, which is exactly what we're going to be showing you here with some of these earnings that are coming our way next week. So let's take a look first at Monday next week. American Express, AXP. You know the story. Stock's been killed. It's all the way down here in the nearly the single digits, and what we like to do is we're looking here at selling the Feb 15 straddle against American Express, trading right around that $14 level. Now what does that mean? That means that if I own the stock and I sell the combination of the call and the put, that's the covered straddle. Not like the one I described when I described State Street. That was a strangle because we sold an out-of-the-money call and an out-of-the-money put. In this case, at the money, selling the 15 straddle rather, and taking in all that premium means that if the stock's 15 or higher, I'm out of the position and I keep that $3 that I got. If it goes down below 15, that means I'm going to be put stock at 15 less the $3 premium. You got it. So my second tranche, I'll be buying at $12, and I'll take that shot. Again, liking the odds. American Express earnings on Monday next week. Also on Monday, Kimberly Clark. And if you need toilet paper, well, Kimberly Clark is one of those places you go to get it, folks. Ultimately, KMB is the symbol here. Selling the March 55 calls against the stock that we own, and the March 45 puts. We would collect for doing that roughly $3, I believe. Take a look at this one, folks. That's a covered strangle again, because rather than the straddle, which is selling the belly, selling the at the money, we are selling an out of the money call and an out of the money put against the shares of stock in KMB. Spin ahead to Tuesday. AK Steel, AKS. Looking at the steel stocks, and I have been, they are dirt cheap. Last week we did some very nice trades in Gradeau, GGB, which is these options doubled for us in one day, and we're looking for some of that same lightning in a bottle, some of that magic here in AK Steel. February 10, 12.5 bull call spread. Take a look at what it looks like right there. That bull call spread, we're establishing it, buying the 12, or rather buying the 10 call, selling the 12.5 call, just putting a limited amount of money on the table. If the stock's $12.50 or higher, the spread goes out to $2. Take a look at this one, AK Steel, Feb 10, 12.5 bull call spread or vertical. Stryker, also earnings on Tuesday, SYK, so implantable hips, knees. It's a medical device company. Take a look at it, SYK, earnings coming at us. We're looking at doing a covered call, just going out and buying Stryker and selling the March. We're buying, giving ourselves a little more time, gives me a little more cushion and comfort, selling those 40 calls against the stock that we're buying in SYK. Again, earnings on Tuesday. Last one I'm going to give you, Wednesday next week, Wells Fargo, WFC. We've already got a bull call spread in Wells Fargo. We paid 80 cents for the 17.5-20 bull call spread. When the stock was down $2 on Thursday of this past week, that spread was still 75-cent bid offered at 80 cents. So you know that there's a lot of folks who are still speculating after the big drop these stocks have had that they're now a little more worried about the upside, because maybe a lot of the downside has already been priced in, and that has moved the odds into our favor. Folks, I'm Dr. J, and this is Time is Money. I thank you for joining us today. Encourage you to check out Option Monster. Great stuff throughout the day, including our thermal imaging, which is free right there on the homepage, and our sister company, TradeMonster.com, where you can trade stock for $7.50 flat, or options for just 50 cents. These strategies I talked about, these graphs that you've seen over here on the screen, those are all from TradeMonster.com. Make sure you check it out and come back next week, because time is money.